pitching a buy for Equity Residential, a residential REIT.
I'm Adam.
Al. All right, our target price is $110.04. We weighted it 50-50 between the comps and a residual income model. We picked residual income over DDM since it took into account capital expenditures. There's a little bit of information on the stock. It closed yesterday at $79. Had a 52-week high of 89 and a 52-week low of 72. Market cap about 28 billion, and shares outstanding of close to 400 million.
And our thesis of why we should buy it is that it will provide long-term steady growth with low volatility within residential REITs and will provide a steady backbone for the real estate sector in our portfolio for future gains.
Here's just a short graph of it compared to the rest of the real estate sector in the last couple of years. Just ignored a little bit at the end with the coronavirus stuff.
The red line is Equity Residential, and the blue line is the spider that we compared it to.
Mm-hmm.
So as you can see, almost every year has outperformed the spider.
And just a little overview of what exactly it is. It's an American-based residential REIT that has the predominant section of its portfolio is in East and West Coast in urban markets, specifically in Boston, New York, DC, Seattle, San Francisco, especially in Southern California. And they specifically focus on high-income housing, which is the biggest part of their strategy. They have high-income housing in the CBD of cities. They focus on high walkable urban environments. This is most exemplified in New York. Of their 37 properties, they have 25 that are on the southern tip of Manhattan, just between the financial district and Madison Square Garden. This limits the amount of competition, since it's not only the properties are expensive, there's a lot of legal and logistical barriers entering such environments. Here's a breakdown of their portfolio. They have about 47% in California alone, and a significant portion of that is just in Southern California and Orange County and LA and San Diego, which, yeah, total about 47% of their net operating income of about 309 properties.
Recently they had a major executive change up where their CEO of about 16 years at that point, I believe, retired in 2018, and they replaced him with their CFO at the time. So they had to basically internally promoted a new CEO, CFO, COO, and then a few days ago while we were making this, their CIO, who's had that position since 2002, has announced that he's going to retire. And we believe this is a good thing because these new executive managers can bring in new strategies and new ideas to the table that can increase their revenues and their net income. And some of the things the company has been recently doing, we believe, is related to that, which we will talk about later on in the presentation. And with the new executive managers, we also believe this shows that the company has a pretty good work environment and that they trust and believe in their managers and their employees to be in these levels to show what they can actually achieve in the working world.
And in 2019, they moved towards leasing property. They had their first property open, and they have had about $500 million of property in leasing alone. This has led to some additional tax benefits. In 2019, they had their first year of negative tax. And this allows them to lower operating expenses because if they lease a property, they don't have to have as much upkeep on it. And over here is just some of the locations that they've been breaking into with Bethesda, Alameda, Cambridge, and then building on some additional ones from previous established environments with Washington, D.C., Seattle, and Boston. Here's a breakdown of a little bit of the average household income of each city, and each of these are significantly above the household average of the U.S. of $60,000, excluding Denver, Boston, and LA. even though these markets do have a significant amount of wealthy individuals in them, it's not the average person is particularly that wealthy. However, unlike Bethesda and San Francisco and New York.
For a housing unit, what they consider as stabilized income is 90% occupancy rate. And overall, across their entire portfolio, they have achieved 95.8% nationwide occupancy.
And this bottom graph shows their sales over the last 6 years. And in 2016, they had a major sell-off, about $5 billion of assets. This is to consolidate it to more East and West Coast. They had a major sale in Phoenix to higher income housing in these more centralized markets. And over this time period, even with the addition of more leasing property, they've managed to keep a low DE ratio of under 1, which the industry average in residential REITs is 1.87. So they've been able to stay consistent over that time. And then here is their funds from operations over that time. It's been able to consistently grow, excluding the massive sale-off because they lost a lot of property. And in the past year, in the quarter 3 and quarter 4, they beat the Zacks prediction for their funds from operations.
One of the big things that the company has been investing in is more green and sustainable projects. Recently, they issued $400 million in green bonds, which basically they said that they were going to use that money from the bond to either build or acquire housing projects that were green, sustainable, and they've allocated about $396.7 million of that towards those projects. This was the first ever green bond ever issued by a REIT in the United States. And on average, they spend about $14 million on sustainable projects. These include stuff like replacing light bulbs with more efficient types like LEDs, replacing appliances with stuff like low flush toilets to lower water expenses, and other stuff such as more efficient watering of like gardens and lawns. And this is a list of the 3 projects that they put the green bond toward. And all of them have a LEED home certification, and a LEED certification is basically this organization comes in and they'll take a look at the property and basically rate to see how green and sustainable it is, and then they'll give it a certification. With Switch Platinum, their project in San Francisco is the highest rating that they can give a property. And they have, in their portfolio, they have about 30 properties that have a LEED certification or an equivalent certification from another organization. Some of the benefits from these green projects, like I mentioned, they spent about 5 years improving the lighting and replacing it with more efficient versions, and that has improved their net income by about $8 million annually. On a lot of their West Coast properties, they have solar panels on the roofs and everything to try to offset how much money they're using from the main power grid of the city. And that currently has a capacity of about 2 megawatts. And over this year, they want to add an additional 6 megawatts, which will lower their overall power usage by 6%. And some of the properties that are currently in this solar project have seen their power usage go down by 80%. And with their East Coast properties, especially in the DC, Boston, New York area, they have these things called cogen systems, which combines the house's gas main, power main, and water main, where it basically is like a second boiler in the house that will use some of the natural gas coming in the gas main to boil water, which will help with the water heater and produces a bit of electricity for the house itself, so it's not as reliant on the main power grid. And of the 25, and they have 25 systems of those currently, and they have about the same capacity as their current solar on the West Coast.
All right, and then talk about a little bit of their dividend payout. They've maintained, for the most part, around or below 100%, which gives them the option to grow over time. And for the last trailing 12 months, they've maintained about an 86% payout ratio. And here's a couple of general residential REIT benefits. In the past about 20 or so years, the vacancy rate has gone down significantly, so now it's below 7%. And over the past 40 or so years, the urbanization rate has increased significantly to about 82.5%, and is projected to continue growing after that. A few large risks with residential REITs, and specifically with equity residential. They have quite a few places that quite a bit of their portfolio in rent-controlled cities like LA, San Francisco, and New York. This will lower the amount of profit they can make from operations and can limit the amount of money that they can put back into the upkeep of these properties. They also, as mentioned, they also had significant executive changes pretty recently. That could be indicative of a bad work environment, of a toxic work environment, but we don't know for sure. And they have had new efficient technologies installed in many of the properties. This most likely will be a good thing in the long run, but it could result in unforeseen costs with specialty services or specialty repair equipment needed. And then with local and economic conditions, real estate is obviously not illiquid, or it's very illiquid. So if something bad does happen, they can't get rid of the property very easily. Also,
finally, a lot of their assets are in areas that could be hit by natural disaster. As we stated, 47% of their asset portfolio is in California, which, as many of you know, is in high earthquake risk area. So let's say like a massive earthquake hits the LA area and it causes a lot of damage. There goes a massive chunk of their portfolio that they have to spend money on repairing, and they're not going to be getting income from because people aren't going to be living there while the repairs are being done.
But also maybe we believe you should buy into this. Do you want us to go right into our sale?
Yeah, well, yeah, yes, go ahead.
All right. Well, we want to sell half of Crown Castle, which would make it about $30,000. Well, one of the reasons is Crown Castle has underperformed in the last few years compared to equity residential, excluding a little bit at the end. There's also, since Crown Castle is a telecommunications REIT, there's a massive threat from space-based telecommunications, most notably with OneWeb, Iridium, and Starlink. Also, the repair payout ratio for the last 4 years has been over 200%. In 1 year, it was nearly 400%. That basically just makes up our sell for Crown Castle.
Okay, guys. I'm gonna start with a couple of questions, then I'll open it up to the class, and then I'll probably come back to more of my questions. But what were the comps that you looked at for the relative valuation?
We looked up Essex, Mid-America, Avalon Bay, Equity Lifestyle. What was there last one? They were all American-based comps, American-based residential REITs that predominantly operated in the American market, specifically in American cities. Some of them specialized in the southeast U.S. or like Mid-America was in the middle U.S., but most part what they were.
So we have Avalon Bay in our portfolio currently. Why do you think that equity residential is more attractive than Avalon Bay?
Because Avalon Bay specifically targets, they consolidated after the 2016 consolidation, they specifically are focusing the portfolio on high income housing in urban environments. And also they've been pushing a lot for green housing, which has been able to reduce their operating expenses and make them look more attractive to new entrants into the new buyers into the market, such as millennials and Gen Z, who are looking for that kind of stuff.
Does the class have questions? I have no shortage of questions, but I want to give you guys an opportunity first.
Yeah. Is there a lot of like tax benefits for green housing, or is it more just to reduce operating costs?
They have a lot of tax benefits in general for being a REIT. Like, their normal tax rate is extremely low.
Yeah, it's like 0.1, 0.5, 0.1.
Yeah,
But there are a bit of benefits.
yeah.
So, do you have any concern, they seem concentrated in these kind of mega cities. You've got LA, San Francisco, New York. Are these cities growing at the same rate as, say, your second-tier cities, like your Austin, Texas, and your Portland? Do you think they might be missing out on a growth trend by concentrating in cities that are already extremely large?
Possibly. We did read that last year in the fourth quarter, the growth in the greater San Francisco Bay Area, because that's what they consider in their portfolio of San Francisco. There's like San Francisco itself, San Jose, Oakland, and all these other cities that are in that area. They had, the growth there wasn't as big as they thought it was going to be, but areas like the greater LA area, especially the Inland Empire, I believe have been growing to, but I do believe,
Yes, I do believe they're missing out on that growth. They don't have any current plans, at least nothing that I could find, to move into specifically Texas, but we'll have to pay attention to see if anything comes up.
So one thing you might consider doing is, first of all, taking I'm sure they probably have this, is a map of exactly where their properties are. And then you can see if they're more in, like you talk about where they're concentrated in New York, and that's clearly like in Manhattan, in central area. But where are their properties located in, say, the greater LA area? I just learned while I was down there that the greater LA area is about 150 miles by about 170 miles.
Yeah.
So it's quite a big difference if you're talking about like properties located in the Inland Empire, which is also a lower income area,
Yeah.
versus, Malibu, where your average house price starts at $2 million.
I did actually take a look at that. A lot of their properties in the LA area are in the actual city of LA itself.
Mhm.
They do have some in Orange County, like, I forgot the name of the town that Disneyland's in, but that's in
Anaheim?
Orange County. Anaheim. Yeah, they have some in that area, and they have like 3 or 4 sprinkled around the Inland Empire.
Okay. I would look at if they give you information on their occupancy rates, I'd look at those relative to whatever else you can kind of glean for an industry average, because those might be hard numbers to find. I would look at the very local growth rates. So, for example, the entire state of California has actually been losing population. But of course, that's not, it's not an even trend. Like, there are some areas losing population, some areas gaining population. So I'd kind of be curious as to where they are located, and if those are growing areas or shrinking areas.
Okay.
The strategy of concentrating on the like high income housing market, what do you guys think about that? Because if you're a renter and you fall into that demographic, you might be in that lucky class of people that could actually go and buy. So is there some concern that maybe they're catering to a clientele that right now interest rates were just lowered another 50 basis points? It might be an attractive time to buy if you're a high income person who has the ability to do so.
So what are the age of the people renting?
We
didn't look into that.
So if you know the age of the people that are renting the properties, you can look at their habits and whether or not they are buyers or renters. So younger generations don't tend to buy as much as the older generation did when they were their age. So if they have a younger demographic that are renting from them, I think that would be the answer to your question.
So they're now leasing some property as opposed to owning property, which is kind of interesting. So I would look into that and see if they would describe it, whether it's a quote-unquote triple net lease or not. Because they're a real estate company, I think they would get into that much detail. And kind of how the leases are structured and why that makes sense for them. Because essentially now they're acting as a property manager because they're leasing property, managing the property and leasing it to someone else. So they're just making this kind of narrow spread as opposed to if they own it, they might have more potential for upside, although also some downside, the risk of ownership. So I'd be interested in kind of hearing more about how those leases are structured. And then the piece around sustainability. So at the end of the day, the question is, why does it matter? Does it actually impact their bottom line? And if so, do they provide like a dollar amount of what they're saving in terms of energy costs?
Overall, from what I could read, because they did put out a report describing all their sustainability projects and trying to go green. Some of their projects, especially on the West Coast, they are focusing now heavily on reducing water usage, especially in California, because that's a major issue there. Because it's been, we've had back home, we had 5 years of drought. Now we're technically out of a drought, but it doesn't look like anything's changed much. It's still a massive issue. And they have said that last year they ended a 5-year project to replace most of the light bulbs in their common areas with LEDs or other such things. And that's where we get the increase in their net income by $8 million annually. So even some of these small things that they're doing to their properties to make it overall add up to a massive benefit to them.
Okay. Yeah, so you generally see companies talk about sustainability for kind of 2 reasons. One, and it does make sense for a lot of real estate companies to do things like change out lighting and conserve energy because it actually oftentimes is a good investment, right? It ends up reducing your costs quite a bit. So there's actually a business case for it. In other, especially consumer-facing industries, you see a lot of talk about sustainability as a bit of a marketing piece because perhaps the residents who might be interested in possibly renting one of the units that these folks offer are interested in sustainability, kind of broadly speaking.
Yeah, that is true.
So I when I look at sustainability initiatives, I try to quantify the value of them as much as possible because I think the marketing value of them sometimes is a little bit difficult to quantify and possibly not very directly evident in their bottom line. So I would comb through and see if you can pick up any other stats like that $8 million increase.
Okay.
Just a comment on payout ratios. So payout ratios for dividends are calculated based on a company's taxable income, which oftentimes is different than so in an ideal world, your taxable income would look as small as possible and your actual income would look as large as possible because you're allowed to make certain accounting decisions in order to reduce the amount of income that is subject to tax. So when you hear a payout ratio like 400%, you're like, how can a company pay out 400% of what it earns? That's based on a taxable income figure. So sometimes it's helpful to put the dividends on dividend to EBITDA ratio or something else to make it a little more apples for apples and take out that weird tax kind of distortion.
Okay.
Could they have done a price to FFO for their relative?
Yeah, what did you use for your relative valuation?
PE.
Yeah, we use the P.
Did you look at the price to FFO?
Yeah,
We did look at it and use it in the actual calculation for the price.
And why was that?
In that entire model, a lot of our numbers that we were getting from putting in what was on their balance sheet and the financial statements were coming out really
So I'm asking about a different type of relative valuation using price to FFO, not the like free cash flow to
Oh, okay.
equity.
We just did think to do it.
Okay, maybe try that because
Okay.
that's a more common metric for
Oh.
REITs. Okay?
Okay.
So how does high-income housing relate to like just the average housing market? I don't know about that. So if there's like we're in a housing bubble and go into a recession, are they affected just as much or more or less? Is it riskier to go into high-income housing or is it not as risky?
I'm not sure.
What do you think about the housing market like right now in those locations?
To be honest, speaking from personal experience with the San Francisco Bay Area, it's kinda, rent prices are pretty extreme over there as is on
Mhm.
average. Like, in San Francisco alone, it's like over 3,000 average now.
Yeah. So did you say your thesis was a defensive stock? Is that what you said?
A stable long-term growth.
Yeah, okay. So do you think it would be better to go with something other than high-income housing? If it's more risky or less risky, like,
We'll need to look more into that, I would say.
I was just wondering, I don't know.
So you have a company here, kind of to Joel's point, that's concentrated in very expensive coastal markets, what we call first-tier cities. Which, kind of making a sweeping generalization here, I think with real estate, it's really important to make sure you're looking at the specific markets that you're talking about, but kind of on a broad generalization here, there have been some second-tier cities that have been growing in terms of adding population, maybe faster than some of those first-tier cities, just because those first-tier cities, at a certain point, you do kind of run out of space. Like, you're familiar with the Bay Area, now people are developing so far out that if you have a job in San Francisco proper, you're commuting 2 hours a day each way in order to get there.
Oh yeah, it's
So, right, so there is just at some point kind of a limit to development, which is for a company that has housing in those markets, maybe to some extent, like a natural limit on its competition, so that might not be a bad thing, but then you're kind of tied to the local economy. So if you have all your apples tied to San Francisco and New York, you better hope that people in finance and people in tech are doing well, right?
Right.
So that would be kind of what I'd think about a little bit, is those two local markets, and are those sensitive industries? Like, how resilient are those two industries? Because I think you're gonna be, like, the fate of San Francisco, whether you work in tech or not, is very much tied to the tech industry. The fate of New York, whether you work in finance or not, is very much tied to the finance industry. So I think a little bit about that.
Okay.
okay.
Okay. Any other questions from the peanut gallery?
I have a question, maybe a concern. You said like 40% are of the properties are in California.
Yeah, 47%.
Yeah, are there any concerns with the like wildfire situation and the drought situation? All of those natural and disaster type stuff.
It is a concern, but especially with I'm trying to remember, it was 2 years ago where we had the two major fires, one that ripped through Northern California near the Redding area, and then one, I believe, hit Malibu pretty hard. It is a major concern, and we'll have to look more into that.
Where's the high-income housing located? Is like in the cities? Is
Yeah, it's like
what matters
in,
with that?
it's, most of their housing is in like the like
Yeah.
major like dead center in the city. So if wildfires were to be affecting those properties pretty hard, we'd have a lot bigger issues on our hand overall.
Can you talk a little bit about the change in management? There were, three members that changed out? Were they, give any insight onto why they left? Were they aging out? And maybe the new people coming in, do they have any proposed change of direction for the company? Or
From what I could see was the old CEO had that position for like 16 years or more. And I believe he was just getting old and wanted to retire. And reading through it, I didn't see anything about like them wanting to make massive changes. But all the people who now have those positions have also been in the company for more than a decade in other positions. Like their current CFO was one of the executive vice presidents and treasurer for the company for about a decade and is now got promoted to CFO. And their CEO now used to be the CFO and he's been there since I believe 2002. They all have a lot of experience working in the company, but they're just new to that position.
So in 2016, their stock took a hit. It says they changed their strategy. Do you know what their previous strategy was?
The previous strategy, they had a lot of assets across the southeast and southwest.
Specifically in
Phoenix, Glendale, Arizona, that area. And what they decided to do was sell off those assets to consolidate in these tier 1 cities. And that's where the stock hit and their massive sale of $5 billion of assets come from in that year.
Okay.